It's 8:31. Welcome everyone to FX Street. Certainly glad you could join us. My name is Adam Rosen. I'll be the host for the next 45 minutes or so. As always, we have a very fun topic to talk about today. We're going to talk about the fourth quarter, specifically the last month of the year, which starts, the next day or so. And we certainly have a lot to talk about in terms of what could affect the market. And we know it's a very tricky time of the year because we have the earnings season coming out of October, November. We have the end of the year. We have the beginning of next year. All these different issues that take place during this period of time. Specifically, one thing that we're going to talk about is taxes. And what we have is a phenomenon called the October sell-off / January effect that takes place. What happens is investors with any kind of profits in the stock market, they sell their profitable positions and also their losing positions at the end of the year to take advantage of the tax benefits. They will rebuy these stocks, and hedge funds and mutual funds will rebuy these stocks at the beginning of the year. That's why, generally speaking, you tend to see stocks go down in the last quarter of the year. That's why October is such a bad month for the stock market, part of the reason. And that's one of the reasons why it's called the January effect. The first 2 to 3 weeks of the year, usually the stock market's quite strong. Now, it's not a 100% predictor, meaning that the stock market goes up every January. It's not just, something we can follow that blindly. But generally speaking, we tend to see stocks sell off at the end of the year and rally the first couple of weeks. In addition to that, we have a very big question. By the end of the year, will the Bush tax cuts, or the Bush era tax cuts, will they be extended? This decision has to be made before the end of the year, before December 31st. So we have at the end of the year, we have not only the stock sell-off, the expected sell-off in the stock market and the beginning of the January effect, where stocks tend to rally, but we also have these Bush era tax credit taxes that are expected that the current administration will not extend, and that will specifically extend taxes to the higher tax bracket or higher taxes to the upper tax bracket, as well as the middle class, and that is looked to be to weigh on the economy and to be a negative. Let's see what they do, but they have again until the end of December 31st, to make this decision. That is just one issue that's kind of political, so it's a little bit difficult to predict what exactly will happen. But, everything, I guess, is sort of political, but we have a lot of other things going on. Specifically what happened in Ireland the other day. Do I have an article about that? Yeah, we have an article about basically what's going on from Ireland to Spain to Portugal, etc. This is on Bloomberg.com. The failure of the Irish rescue to stem a sell-off across Euro-region bond markets may spell more bailouts to come, starting with Portugal. The cost to insure Portuguese debt against default rose to a record today, and Spanish bonds slid the most since the euro's debut. For a second day, highlighting investor concerns, the officials lack the tools to contain a debt crisis threatening the currency's survival. Now, that's in Portugal and possibly in Spain. We know what happened in Ireland just over the past week. It was, an 80 billion, I believe 30 billion or 80 billion, I can't remember the number, multi-billion dollar, 85 billion euro aid package to prevent Ireland from facing certain financial doom, and it did not seem to help. The belief is that this will spread now to other Western European countries like Spain and Portugal. Germany has the lowest unemployment rate. I believe the unemployment rate reported today, the lowest in quite a long time. So Germany's a different type of economy. So next month stocks should go down. Generally speaking, yeah, but usually you see the stock market go down not in December, but October, November, because the market tends to anticipate when those of us with profits in the market will take our profits. Usually that happens October, November. I was kind of surprised to see it did not happen. But then again, the stock market has been quite strong. So there's nothing saying that the trend has to stop exactly in October. So point being is that expect stocks to continue, I would say, lower throughout the month of December. We're going to take a look at the charts in a moment. But the Dow has certainly made a turn back to the downside, as well as other markets. But what is really driving the market these days, over the past couple of days, is the bailout for Ireland and the thought that this debt contagion could really spread to Portugal and to Spain. This is from Bloomberg.com as well. Spain's banks may struggle to refinance about 85 billion euros in debt next year as costs surge and concern continental Europe's fourth biggest economy may need an Irish-style bailout. There's a universal dumping of Spain going on, said Andrea Williams, who helps manage about £623 million, including shares in Banco Santander. The fear, she says, is that Portugal, Spain, and Italy are now in line after what happened in Ireland. And we all know that obviously is contained by the euro, and therefore nothing really good to report about the euro. We have some other news in terms of the European economy earlier today as well. European inflation held steady and unemployment rose to the highest in more than 12 years as the economy's recovery loses some momentum. Consumer prices rose 1.9% in November from a year earlier. The jobless rate increased to 10.1% in October, the highest since July of 98, from 10% in September. Now we know the two sides of the coin that we should consider when we're trying to guess if the European Central Bank, like any central bank, will raise or lower interest rates, is the growth side, meaning GDP, and employment. Employment should rise. Unemployment should go down. That is not the case in Europe. And then we have the inflation side, consumer prices, CPI. Well, Euro area consumer prices rose 1.9%, but that does not really represent a tremendous rise. Remember, what's the target, the inflation target in the Eurozone? Near the 2% level. So, given that that CPI is still under 2% and unemployment is rising, not a lot of reason for the European Central Bank to raise rates anytime soon. And put that together with what has happened in Ireland and what is thought could happen in Spain, Portugal, and Italy, not a lot of reason to buy the euro. I think that's one of the reasons why the euro has really sold off so drastically lately over the past couple of days and I'd say even week. What other issues do we talk about coming into the end of the year or the beginning of next year? On Bloomberg.com, U.S. online sales this holiday season are poised to climb the most since 2007 as retailers entice consumers with free shipping and half-off deals. Now, we know about Black Friday. That's a Friday after Thanksgiving. And now they call it Cyber Monday, which is all the cyber sales, all the online sales that take place the Monday following, meaning yesterday. E-commerce sales on Bloomberg.com, they report. E-commerce sales in November and December will rise 11% to $32.4 billion. Researcher Comscore said last week, an increase from its previous forecast to as much as 9% growth. Online sales today, known as Cyber Monday, because consumers increasingly log on to shop the day after the Thanksgiving weekend, may top $1 billion for the first time, said Sean Milne, Janie Montgomery Scott LLC analyst. All right, so they said growth is continuing to improve, and that's good. And we know that the retail industry represents one of the largest components of the entire economy. And within the retail sector, we know the end of the year, the holiday shopping season, is the most influential part of all the retail sales. So the next couple weeks are really very critical. If they're really good, well, that could improve the economy, trickle-down effect on employment rises, consumer prices rise, GDP rises, non-farm payrolls improve as well. That could really help us turn the corner. And what's good for the U.S. obviously would certainly be good for other nations, and this could lead stocks higher. This could lead, a lot of different equity markets all over the world higher for sure. It could also lead a lot of these currencies higher that have certainly been in a lot of trouble. Now, lately the stock market has gone down. And take a look at the charts in a second. Lately the stock market has gone down and the dollar started to rally because the dollar and the yen and the Swissy are still those low-yielding currencies. And they're treated as a flight to safety when things go bad. Stock market goes down, the dollar, the yen, and the Swissy go up. But if we think that these e-commerce sales and overall the holiday shopping season sales will improve the economy and really pull us out of what's the worst part of it, then we would not necessarily buy the dollar or buy the euro, but we would look to those economies that are performing the best and buy those currencies where the central banks, we think, have the best chance to raise rates. We talk about this during our other webinars, Central Bank Review, where we examine the most recent central bank statements to try to make an educated guess who will raise rates next. Reserve Bank of Australia, Bank of Canada. That's two likely candidates, by the way. Between now and December 31st, we have a number of big events. This is from FX Street's economic calendar. These are only the really big events. We have in the European Union, well, we just had a consumer price index with Canadian GDP, gross domestic product, that was just released as negative 0.1%, falling short of the consensus of 0.2% in the previous result of 0.3%. We have consumer confidence a little bit later on today. In December, we have GDP in Australia, China manufacturing PMI, U.S. ISM manufacturing figures. These are only the really big numbers. We have Swiss GDP, EU, European GDP as well, gross domestic product. We have a European Central Bank interest rate decision. We have the unemployment rate in Canada, non-farm payrolls in the U.S., along with the unemployment rate, the Reserve Bank of Australia interest rate decision, Bank of England interest rate decision, the Federal Reserve will decide on interest rates, Swiss National Bank interest rate decision, and the Bank of Japan interest rate decision. In other words, we have a lot of interest rate decisions between now and the end of the year. Here's from another page on FX Street. Bank of Canada, England, Japan, European Central Bank, Federal Reserve, Swiss National Bank, Reserve Bank of Australia, all scheduled to take place in December. Bank of Canada at 1%, Bank of England at 0.5%, Japan at 0.1%, European Central Bank at 1%, Federal Reserve at 0.25%, Swiss National Bank. I don't see any changes, any expected changes in any of these interest rates. However, we certainly do know that it's certainly much more expected, not only what the central bank says, or what the decision is, whether to raise rates or keep them steady, but also their forward-looking mechanism, what they're looking forward. Now, they're expected not to raise rates in any of the major central banks we covered. But what will the Bank of Canada say moving forward? What will the European Central Bank say moving forward? So we have, quite a few issues so far to discuss. Now, on top of that, let's get to the charts because we seem to make an interesting turn. Here's the Dow Jones Industrial Average. This is a futures chart. The symbol is YM. Daily chart, 10,947. Yesterday lows hit 10,911. Breaking below those lows would go back to mid-October. But what is really very, very obvious, I think, is the head and shoulders pattern. Not the only head and shoulders, by the way. First shoulder high extended to 11,194. Those are the highs of the futures on October 25th of this year. Then we had the head at the top at 11,423 November 5th. Second shoulder high, 11,239 more recently on November 22nd. First and second shoulder should come in pretty close together, which they did, excluding that one outside high of 11,239, which, by the way, did hit highs of 239, but closed at 11,156, back below our suspected resistance. That shows us a likely turn back to the downside. Now, head and shoulders, we know, tend to break in the opposite direction of the head, which is to the downside. And we would look for a break below the shoulder line, which arguably, it's probably around 10,945. The lowest low is actually yesterday. A close below 10,900 could certainly bring us lower. Take a look at the difference. 10,900 to 11,190 gives us a spread of, 200, 10,009 to 11,002. Yeah, about 1,000 pips, 1,200 pips difference. We take that 1,200 pips subtracted from the bottom. That gives us 9,800. Actually, a little bit less than that. Projected support Could be our former resistance up at the former highs of 10,678. Notice, and that's, by the way, those are the highs going back to August of this year. Notice, by the way, we also broke this trend line going back to the beginning of September. So the Dow Jones Industrial Average certainly paints a picture that, well, we're below this trend line, head and shoulders forming. It is likely, I think, we're going to see lower stock prices in the future as opposed to higher ones. Take a look at another head and shoulders. This is the price of gold. Gold futures at $1384.50. Now, could be a head and shoulders first shoulder high, I think, $1387.10. Those were the highs going back to October 14th of this year. $1387.10. Today's high so far, $1386 even. In other words, we should not go too much above 1400. If we break above the head of 1424.40 November 9th, that's a different story. But if we turn back to the downside, this could also represent a reversal in gold. And if we do, of course, that would also represent a break below this very long-term support line going back to July of 28 of this year. We've already started to challenge the support line. But again, we need to remain below 1400. And we really need to see gold break below 1350. I think a break below 1350, especially closing candle below 1350, could certainly bring us a lot lower. So stock market has started to show signs of weakness. The gold market, which is not really showing signs of weakness quite yet, looks like the Dow did a couple weeks ago. Here, I'll show you the difference. Here's the markets. Here's gold. Head and shoulders still above the trend line, but a head and shoulders forming. Here's the Dow Jones Industrial Average. We broke below the trend line, head and shoulders did form, and now we have a strong candle to the downside. This is the Dow, and this is gold. So it kind of looks like the Dow is just a few candlesticks ahead of gold, like a before and after. That is oftentimes the case. Sometimes these markets will kind of delay one another for a couple days. As stock markets have started to weaken, the lower yielding currencies like the dollar and the yen start to rally. And you put a very weak, a strengthening dollar, I should say, against, remember, fundamentally what has been a very, very weak euro, and we really have the turning point and a perfect storm of currency markets. Strong dollar, weak euro, euro dollar, 129.87, back below 130, back below an uptrending support line. We started back in June of this year. In fact, the next significant low takes us down to 125.87, 126 level, going back to August of this year. So as the dollar has started to strengthen and as trouble has really set in the Eurozone, and the euro, for some reason, seems to be the favorite currency for everyone to sell these days because it seems to have the worst news out there. Excuse me. So what we're looking at is a euro dollar that is breaking all kinds of support levels. Not a lot of reason to buy it. Pound dollar, same situation, 154.98. The next significant low, and we did already break our support line down near 153 lows going back to early September. By the way, we had some news coming out of the UK earlier today as well. UK, and this is on Bloomberg.com, UK consumer confidence unexpectedly dropped to a 4-month low in November as looming public spending cuts dented Britain's outlook for 2011, a report by GfK NLP Ltd showed. The index of sentiment declined 2 points to minus 21, the research group said in an email statement today in London. Economists did predict no change from minus 19 October, according to the median 13 forecast in the Bloomberg News survey. A measure of sentiment on the economy for the coming year fell 2 points to minus 22. So, consumer confidence does not look good in the UK. Now, overall, going back to the pound dollar chart, I certainly am a lot more optimistic that the Bank of England will raise rates sooner than the Bank of England's. Because when we talk about the European Central Bank, we talk about Ireland and Spain and Portugal and possibly Italy now, and the debt contagion. And we do not see that so much in the UK. I think things are a little bit stronger in the UK, so I certainly would expect the UK to recover faster than the ECB. or the European Union. However, when bad news enters the EU, the bad news sort of spreads all over the area, and I think that's one of the reasons why you're seeing the pound weaken. The dollar also on its own is quite strong too. But today's consumer confidence numbers certainly do not help. And again, the next plausible support on the pound is down near 153. The trend is your friend. The immediate trend is certainly to the downside, and we did break support lines. So I would not try to pick bottoms in the pound yet. On a shorter-term basis, we could look for a rally to sell shorts, but at the moment, the immediate trend is very much to the downside. Now, the dollar trend to the upside really is very significant because we can even see signs of it on a monthly chart on the dollar Swissy 99.84. Remember, last month we hit lows of 94.61. We said, wow, 94.61 actually was below 96.48 lows. Going back to March of '08, a little bit of a lower low, falls breakout, dollar Swissy turns back to the upside. Now, it's a very scary trade to look for this double bottom and say, yeah, let me buy the dollar Swissy. If you were to ask me, I think the dollar Swissy continues to go up. Downtrending resistance is near 116. And it does, even at these levels, represent a really nice risk-reward ratio. However, fundamentally, I really do not feel comfortable with the trade. Now, when the fundamentals and the technicals don't agree, I think the best thing to do is just to set aside and look for a better trade. But I think it's important to discuss because it is a glaring monthly chart double bottom pattern, and I'm sure a lot of traders are trying to pick the bottoms. Now, technically, I like the trade. I mean, it kind of looks like it's reversing, especially after the market makes a lower low and then fails to really continue lower and then goes back to the upside. Yeah, that really makes me feel good that all the sellers are washed out and all the buyers are getting back involved. But fundamentally, what are the chances that the Federal Reserve will raise rates anytime soon? Not very, very high. I would say probably not until the third quarter of next year. I mean, yeah, holiday shopping season, at least by some reports, looks a little bit promising. But remember, we have unemployment at 9.6%. We have non-farm payrolls not showing a tremendous amount of improvement. Excuse me. Consumer prices not showing a tremendous amount of improvement. A housing market near the lows and not showing almost any signs of improvement at all. And a lot of economists say the housing market got us into this mess. The housing market has got to be what gets us out of this mess. And so far, that's not really occurring. We have the looming question, will the current presidential administration extend the Bush-era tax cuts? That level of uncertainty is certainly not boding well for the stock market and the overall U.S. economy. There's still not a lot of reasons to get excited about the U.S. economy. So why would the dollar go up? It's not so much because we anticipate the Federal Reserve will raise rates, but rather the dollar's going up in sympathy to the stock market that goes down. When stocks go down, bonds go up. And when the bonds go up, well, then we see the dollar tends to rise. So I think that's the reason why the dollar's rallying. I think the dollar did very much sell off. But again, fundamentally, I don't love the story. Dollar yen 83.53. Actually, yesterday hitting highs of 84.39. But if we break above those highs, the next big step is a 38.2% Fibonacci retracement level near 8,600. Dollar yen, of course, is not a very, very easy currency pair to trade. But the immediate trend does look like to the upside in the dollar. But beware, because again, I would not want to buy the dollar yen just like I don't want to buy the dollar Swissy. Because remember, if stock markets go down, we'll buy the low yielding currencies like the Swissy and the dollar, but also like the yen. And I think the yen has a much better chance to go up. Not because the Bank of Japan is more likely to raise rates, but because the Federal Reserve is so much less likely to raise rates, and there's so many more negative issues that are going on in the U.S. Not to say that Japan is out of the woods by any means. A little bit earlier today on Bloomberg.com, it was reported Japan's industrial production decreased and the unemployment rate unexpectedly climbs in October, providing early signs that the country's economy will likely shrink this quarter. Factory output declined 1.8% from September, the sharpest drop since February of 2009. The trade ministry said in Tokyo today. The jobless rate increased to 5.1% from 5%. Remember, European unemployment rate's at 10.1%. U.S. 9.6. Japan is only at 5.1. And the economy lost 180,000 jobs, the most since May, according to the Statistics Bureau. Bond prices rose as a result of that. So we're not exactly out of the woods in terms of Japan either. But I would expect the yen to rise, and that's one of the reasons why I don't think this dollar-yen rally is for real. Dollar-CAD is always very, very tricky because lately, over the past few months, actually going back to May of this year, as the dollar goes down, the CAD goes down. As the dollar goes up, the CAD goes up. And unless we see a real breakout, I would think it would start first out of Canada, that we would expect the Bank of Canada to raise rates. As the CAD rallies, we would expect the dollar-CAD to sell off. But so far, this range-bound chart is telling us that even if we kind of speculate there will be some sort of interesting story in terms of Canada, it's not happening soon. Aussie dollar weekly chart is a much more logical trade at 95.70. We hit lows earlier this week at 95.43. Now, we know Australia is one of the largest producers of gold, and we know gold has gone up as the dollar has gone down. Now the dollar is starting to rally, gold selling off. Perfect storm for the Aussie dollar. Look for former resistance to become new support on gold. Look to the former highs of 93.88. That goes back to April of this year. We did just break the trend line. Now we could go lower, but the next logical former resistance could be our new support. And again, that's near 9,400. If we break 9,400, then look to what could be a neckline of an upside down head and shoulders, and that's near 8,600. Kiwi dollar has also drastically broken to the downside, 74.20. Former resistance could become new support, but look to the 7,400, which is not too far away, near 7,400. Could expect a bounce. If not, I think Kiwi could certainly go a lot lower against the dollar, near 69 and change, 69.5. Now remember, stock markets go down, the yen goes up, and the euro-yen really has gone down. Declining triple bottom. Then we had this really negative news coming out of the Eurozone. That did not affect the euro-yen too much because the yen was still very weak. And then we started to see stock markets go down and the yen rally. So a strong yen against a weak euro. I like it even better than the euro-dollar short as the euro-yen short. Unfortunately, if we're not in to win, we really kind of missed this trade already. 108.48. We hit lows of 108.42. Now, we could see a double bottom pattern. The lowest lows we've seen go back to 105.42, August 24th of this year. But euro-yen could also break lower. We do not know how low this is going to go. Be very, very careful. Anticipate a possible support of right around 106. But if we break below 105, look out. That would bring us to levels, weekly charts, monthly charts. If we break below that, monthly charts show us we have to go back to 2001 to see lower lows. The overall monthly chart, long-term, very long-term trend is also very much at the downside. So there's a lot of weight sending the euro-yen lower. But it's only just the beginning. Euro-yen, a huge move. Take a look at today's highs of 110.68, the lows of 108.40, over a 228 pip range. From low to high today, from high to low. Cable yen is starting to weak. Notice not as dramatically as euro yen, near the 129.60 level. Very big lows, the lows at 126.43. Aussie yen weekly chart at 79.86, really holding so far. I think these yen crosses will continue lower though. 75.14, 7,500 represents uptrending support. Kiwi yen at 61.88. We had a former resistance, suspected new support, but that was above us near the 62.30 level. The next big low is down near the 60.5. And CAD yen also turning to the downside. Notice at different degrees of strength or weakness. The lowest low 78.39 going back to August 22nd of this year. So we have yen crosses all kind of cracking, some faster than others. It really does take two stories. You know, the stock market selling off sends the yen higher. That's one story. But then we have the Eurozone. And again, the issues that we've seen in Ireland, Spain, Portugal, and Italy lately, excluding Germany. And that has really sent the euro lower. And that makes a difference between a Kiwi yen, which is what's down kind of a lot, Here's a Euro yen, Aussie yen daily chart. That's kind of down a lot. But the Euro yen has really gotten clobbered, and look, it shows very little signs of reversing anytime soon. Now I find it kind of funny, and I hope you do too, that when we look at these markets, and it's obvious that the sentiment has certainly turned more towards the negative, all of a sudden, we will see the stock market focus on these negative stories. And I think that is maybe partially due to the fact that, and I think this is the overwhelming theme that it's always important to keep in mind. When the stock market goes up and things are optimistic, we buy certain currencies and we sell other currencies. We buy the higher yielding currencies like the Aussie and the Kiwi, and we sell the lower yielding currencies like the dollar and the yen. And we might also speculate. I know I turned the charts off for just a moment. We might also speculate to buy the euro or buy the pound if we think that, or the Bank of Canada or the Canadian dollar, I should say, if we expect those central banks to raise rates. That's when things are good. Stocks go up, high yielding currencies go up. Maybe we'll buy some other currencies that we think those central banks will raise rates, like the Bank of Canada. And we'll sell the low yielding currencies like the dollar, yen, Swissy. When things look negative, when things look pessimistic, we sell stocks. We sell our high-yielding currencies like Aussie and Kiwi. And we buy our low-yielding currencies like the dollar and the yen and the Swissy. And we also may sell short those currencies with an unusual story that is extra negative, like the Eurozone lately. Notice how, I think it's probably the phenomenon of the financial writers for Bloomberg.com or any other website, and some of them are really, great analysts. But I think the tendency is they tend to find the stories to explain the market. The market goes down, let me look for a bad story. The market goes up, let me look for a good story. Over the past couple months, we have heard almost everything good and nearly nothing bad coming out of Australia. Certainly there has been a lot of good news to report out of Australia. They are one of the large producers of gold, and gold has hit record highs. And the Reserve Bank of Australia has raised rates quite a few times already, faster than any other central bank. And I think if things improve at all on a worldwide basis, Australia will certainly continue to raise rates. But notice how things start to get a little bit pessimistic, and we see a negative article about Australia. Just as anecdote, Australia's economic growth, this is on Bloomberg.com. Australia's economic growth slowed last quarter as higher borrowing costs and less government stimulus weakened the housing markets, while a stronger currency hurt exports. Economists predicted a government report will show. They say GDP, gross domestic product, advanced 0.4% from the previous 3 months. When it grew 1.2%, according to the media of 26 releases the report tomorrow at 11:30 a.m. in Sydney, 6 days before the central bank holds its final policy meeting of the year. Now, I do not disagree with this article. If they say they think GDP has weakened, or the anticipation in GDP will weaken, yeah, I agree with that. And I don't think this is going to bode well for the Reserve Bank of Australia to raise rates. I don't think they will raise rates, not with this negative sentiment out there. But the GDP, their prediction, advancing 0.4% the previous 3 months, that prediction is based on the previous 3 months. That prediction is not just based on yesterday. Why did we not hear about this negative prediction over the past 3 months? If you were to go back in time and look at Bloomberg.com or Reuters or any financial website and look for stories about Australia, you would see an overwhelming, I'm guessing, 80-90% of the stories are printed about the Australian economy were positive. And I think that is just one of the phenomena that takes place in financial markets. When the stock market goes up and things are optimistic, again, higher yielding currencies go up, things look better, and economies improve, we look for stories to sort of explain that. Explain why the market's going up. Explain why things look good. Not that I think the economy today is any different than it was yesterday or last week in Australia, but I think last week you probably saw some rather positive news reported out of Australia. I mention all this not to discredit Bloomberg at all, because it is certainly a fantastic news site, but more just to, I think, make everyone aware that this is what happens. Stock markets go up, we like to read about good news. Stock markets go down, we like to read about bad news. We heard so much bad news that was reported in the U.S. over the past few months. Housing market near their lows. Unemployment rate stays unchanged at 9.6%. Consumer price is really lackluster. But the stock market still, the Dow Jones Industrial Average, still above 11,000. Well, it was until yesterday. Notice the opposite's now occurring. That now that we read these like optimistic stories about Cyber Monday, Black Friday, holiday shopping, better than expected, etc., and yet the stock market continues to go down. Now, how do we make sense? Do we buy when there's good news, or do we sell when there's good news? Point being is, I don't think we can really trade off the news on an individual basis. I follow the theory that I think the market's going to do what the market's going to do, and we can detect those changes and those trends by the technical analysis, the charts. But the market, I think, will focus on good or bad stories depending on which way the market kind of wants to go. Which way does the market want to go? You count how many buyers and how many sellers out there. You take the majority, and the majority wins. Right now, I'd say there's a greater amount of sellers. Let's go back to the Dow trend. And I'll show you what I mean. Over the past few months, and more than months, actually years, here's the Dow Jones Industrial Average. Let's go back to the beginning of this tremendous rally. We hit a bottom on the Dow, going back to lows near 6,500 in the year 2009. Now, from March 2009. From March 2009, we rallied. Sold off a little bit and then sold off more, but rallied even higher, up until the eventual highs of 11,300, 11,400 November of 2010. So March of 2009 to November of 2010, that gives us, 11 minus 3, that's 1 year and 8 months. 20 months of stock market basically going up more than it went down. Over this period of time, I would guess, if you read articles about the U.S. economy, there were a lot more negative as opposed to positive articles about the U.S. economy. Why did the stock market continue to go up rather than go down, even though there was an overwhelmingly amount of negative articles versus positive articles? And not just the articles, the news. I mean, unemployment is near 10% this entire time. Consumer prices are almost nothing during this entire time. The housing market, very, very close to its lows, all-time lows since 1960s. Yet the stock market is near the highs. Well, what's the reason? I think it's a larger reason than the housing market or retail sales. It's interest rates. A low interest rate environment is good for stocks because companies can borrow more money. Individuals, consumers can borrow money at a cheaper rate to buy new homes, to buy new automobiles, to buy new consumer electronics, credit cards, etc. And a low interest rate environment essentially is good for the economy, and I think that's why stocks have gone up. Now, we're not going to see it so fast in the big numbers like GDP and CPI and non-farm payrolls that there's a trickle-down effect, and you need that to take more time. You need more time for that to take effect. Also, remember, stocks, it's a market. And a market, like any market, is a forward-looking mechanism. So the stock market went up a lot, I think, based on the anticipation that the economy will improve based on the low interest rates that we see now. You say, what do we have now? Well, then I think I'm going to have more money in the future. What about the U.S. dollar devaluation? It's a great point. I think that also does play an important role. We know with the creation of the stimulus plans, the TARP, Troubled Asset Relief Program, the different stimulus plans used to bail out the banks and bail out the automakers and all these other great companies. The Treasury has printed more money upon request from the Federal Reserve. The low interest rates, in addition to the Treasury printing all this additional money, has devalued the dollar. That's one of the reasons why the dollar is so weak. It's kind of like a stock split, but your stock doesn't double. You just have more dollars out there. So every dollar that we have in our bank account is worth a little bit less. That gives the euro a little bit more buying power, and the pound a little bit more buying power, and the Aussie a lot more buying power. Well, that weaker dollar essentially, and eventually, I should say, attracts investments. Because remember, the U.S. is a capital investment type of economy as opposed to an export-driven economy like Japan. The U.S. economy benefits from foreign investment measured by the tick data into our equity markets, into our housing markets, into our small and large businesses from overseas. So a weak dollar just makes Microsoft stock and oil-denominated dollars and our food and everything else that much less expensive to overseas investors. I think that's one of the reasons why the stock market's moved. Now, the point to this entire soliloquy here is that notice that we had very, very bad news that was released over the past couple of years, and the stock market went up because of a low interest rate environment. And this low news actually supported our belief that the Federal Reserve was not going to raise rates. Well, guess what? Now, as the news starts to look like, at least in terms of retail sales, starts to look like it's beginning to improve a little. Will the Federal Reserve keep interest rates at zero forever? Less of a chance of that. Will the Federal Reserve raise rates? Well, probably not anytime soon, but sooner than we thought maybe a month ago. Better news means the Federal Reserve is more likely to raise rates. The Federal Reserve is more likely to raise rates. These very, very low interest rates that we have taken advantage of, hopefully, to buy new automobiles and cars, same thing. Automobiles and houses and invest in small businesses and take small business loans. I know the credit conditions have not been easy, probably the worst ever. But regardless of that, this low interest rate environment has stimulated stocks. As the news starts to improve, it means the Federal Reserve is less likely to keep rates this low, more likely to raise rates, and that means that the free interest rates party is almost over. At least that's what the market thinks. And I think that's why the stocks are starting to go down. So, ironically, I think you could see good news will send stocks lower. Put that into respect with, we have the end of the year expected sell-off of the stock market because people take profits in the stocks before the end of the year for tax reasons. And we have the looming question, will the current administration extend the Bush-era tax cuts? So far, no decisions have been made, just a lot of politicking. And we have the trouble in the Eurozone, including Ireland, Portugal, Spain, maybe Italy at this point. A lot of uncertainties. I think overall is going to send the stock market a little bit lower as opposed to higher. I think we could see some strength the first couple weeks of January, but please be aware that once the trend moves to the downside, the January effect could just simply be sideways trading action waiting for February for the stock market to go lower. So we have a number of we have the tax issues in terms of selling stocks before the end of the year. We have the tax credits that we really do not know what's going to happen yet with the contagion from Europe. We have negative news coming out of the UK and Japan earlier today as well. A lot of uncertainties. This all translates to a big question mark in the stock market. I think you could see lower prices in the future. Again, January effect, we could see higher prices in the stock market, but I would not expect very, very much higher prices. When European stocks go up, is it good for the euro? Well, European stocks, if they go up, it's a reflection that we think that the Eurozone economy is improving, and that certainly would benefit long-term to the euro. But I think the euro, European stocks does play a role, but I think when we talk about the euro currency, we have to look at the big picture in terms of the growth side. Employment, gross domestic product, the inflation side, like consumer prices, consumer price index, producer price index, what is happening in the stronger economies like Germany, what is happening in the less strong economies like Ireland and Spain and Portugal, etc. And what is the anticipation, putting all that together, that the European Central Bank is going to raise rates anytime soon. I think in terms of the euro takes into consideration a really, really big picture. Stocks, focus on stock-specific news. Led overall, the trends are created by the interest rate environment. But, BP or Microsoft or any stock out there will go up or down based on stock-specific news. With that said, I'm out of time. However, if you want to contact me directly, please feel free to do so at www.forexlounge.com. I want to thank you very much for joining us. Very special thanks to FX Street. By the way, please see their calendar because we have a lot of good stuff to talk about in the time to come. Again, we thank you very much for joining us. We wish you a great day, all profitable trades. And we look forward to seeing you back soon.